In 1989, a quiet revolution began that would change the financial lives of every American forever. Before this year, getting a loan meant sitting across from a bank manager who would judge you based on personal relationships, gut feelings, and often discriminatory practices. Your race, gender, or social connections mattered more than your actual financial behavior. Then Fair Isaac Corporation introduced something called the FICO score, a 3-digit number that promised to make lending fair and objective. But did it really? Today, this mysterious number controls whether you can buy a house, rent an apartment, get a job, or even qualify for basic utilities. Yet most people have no idea how it actually works. Welcome to the hidden system that's been controlling your financial life for over 3 decades. Your credit score determines your access to the American dream, but the rules of the game were written without your input, and the system profits every time you check your own number. Let's expose exactly how this works. The credit scoring system didn't exist for most of human history. Our grandparents got mortgages through handshake deals with local bankers who knew their families. But as America grew and people became more mobile, banks needed a new way to assess risk across strangers. The credit bureau system emerged in the early 20th century, with clerks manually recording payment histories in dusty ledgers. These bureaus operated in shadows, collecting information about you without your knowledge or consent. By the 1970s, this system had become so problematic that Congress passed the Fair Credit Reporting Act to give consumers some basic rights. Still, credit reporting remained a fragmented mess until computers made it possible to standardize everything into a single score. Fair Isaac saw an opportunity. They created an algorithm that could digest your entire financial history and spit out one number between 300 and 850. Banks loved it because it was fast, cheap, and removed the appearance of bias. But here's what they don't tell you. That score isn't measuring how responsible you are with money. It's measuring how profitable you are to lenders. Think about that distinction carefully. The system rewards people who carry some debt and pay interest, not people who avoid debt entirely. Someone who pays cash for everything and never borrows might have a lower score than someone making minimum payments on 5 credit cards. The algorithm doesn't care about your savings, your income, or your actual wealth. It only cares about your borrowing behavior. Your score is calculated using 5 main factors. Payment history makes up 35%, which seems reasonable until you realize one missed payment can haunt you for 7 years, while decades of perfect payments barely move the needle. Amounts owed account for 30%, but this isn't about total debt. It's about utilization ratios and arbitrary thresholds that most people don't understand. Length of credit history is 15%, which punishes young people and immigrants starting fresh in America. New credit inquiries cost you 10%, meaning shopping around for the best loan rate can actually hurt your score. And credit mix rounds out the final 10%, rewarding people who juggle multiple types of debt simultaneously. Notice what's missing from this calculation? Your salary, your education, your work history, your assets, your rent payments, your utility bills paid on time for years. The 3 major credit bureaus, Equifax, Experian, and TransUnion, operate as private corporations that collect your financial data without paying you a cent. They gather information from banks, credit card companies, collection agencies, and public records, building detailed profiles of your financial life. These companies then sell this information about you back to lenders, employers, landlords, and insurers, generating billions in annual revenue from your personal data. You are the product, not the customer. Even better for them, the law requires creditors to report your information for free, but charges you money to see your own credit report more than once per year. When Equifax suffered a massive data breach in 2017, exposing sensitive information of 147 million Americans, the executives sold their stock before announcing it publicly, and the company faced minimal consequences. Your social security number, birth date, and addresses were compromised, yet Equifax's business continued largely unchanged. This incident revealed the terrifying truth that you have no control over who holds your data or how securely they protect it. Now let's talk about how the system keeps you trapped. Every time you apply for credit, the lender performs a hard inquiry that lowers your score. Every time you close an old credit card to simplify your finances, your score drops because you've reduced your available credit and shortened your credit history. Every time you pay off a loan completely, your score might actually decrease because you've reduced your credit mix. The system is designed to keep you perpetually borrowing, perpetually paying interest, perpetually feeding the machine. And if you try to opt out, good luck renting an apartment, getting a cell phone plan, or sometimes even landing a job. Employers in many states can check your credit score and deny you employment based on financial stress, creating a vicious cycle where bad credit prevents you from earning the income needed to improve that credit. Insurance companies use credit-based insurance scores to determine your premiums, meaning financial struggles can make your car insurance unaffordable right when you need it most. The score has become a social credit system in everything but name, yet it operates with minimal government oversight and maximum corporate profit. Medical debt is particularly cruel in this system. An unexpected hospital visit can destroy a credit score built over decades. Until recently, medical collections appeared on credit reports immediately, and even under new rules, they still appear after significant delays. Meanwhile, the credit bureaus fought against, including positive alternative data like rent and utility payments, because that might help people improve their scores without taking on profitable debt products. So what can you do? First, understand that improving your credit score means playing by rules designed to benefit lenders, not you. Check your credit reports annually from all three bureaus for errors. Dispute inaccuracies aggressively, because the bureaus profit from volume and accuracy is not their priority. Keep credit card balances below 30% of limits, ideally below 10%. Never close old credit cards, even if you don't use them, because age matters. Set up automatic payments so you never miss a due date, since payment history weighs so heavily. But more importantly, recognize this system for what it is. A private infrastructure that has inserted itself between you and essential aspects of modern life, extracting profit at every turn while claiming to serve the public good through objective measurement.